Something has gone wrong in Europe, and it did not happen slowly. It happened fast enough that most people only noticed once factories started going dark. This is not a single plant closing because of poor management or bad luck. This is a pattern spreading across Germany, France, Italy, and Central Europe at a pace not seen in generations. Chemical plants, steel mills, fertilizer producers, glass makers, all announcing shutdowns or permanent relocations. And here's the key point that changes how we should read this moment. This is not a normal recession cycle. It is not demand collapsing because consumers pulled back. This is supply being deliberately made more expensive and less reliable inside one of the most industrialized regions on Earth. That is why this moment matters. Europe did not lose competitiveness because others became better overnight. It lost competitiveness because its own cost structure crossed a line that heavy industry cannot survive. Once that line is crossed, production does not pause, it leaves, and when production leaves, it rarely comes back. For decades, Europe built its economic power on a simple foundation: stable energy, predictable regulation, and dense industrial clusters that fed off each other. That system produced high-value jobs, exports, and geopolitical weight. What we are witnessing now is that foundation cracking under policy choices that underestimated how physical industry actually works. Energy is not just another input you can substitute easily. It is the bloodstream of industrial economies. When energy becomes volatile, expensive, and politically constrained, everything upstream and downstream destabilizes. Governments framed recent decisions as temporary pain for long-term independence. But industry does not operate on slogans. It operates on margins, timelines, and certainty. When those disappear, capital moves, skills migrate, supply chains unwind. This is why factory closures are not just an economic headline. They are a strategic signal. Europe is discovering in real time that industrial power once lost is almost impossible to rebuild at scale. And this realization arrives at the worst possible moment when global competition is intensifying, not easing. What follows is not just slower growth, it is a reshaping of Europe's role in the world economy. To understand how Europe reached this point, you have to look at the energy decision not as an environmental goal, but as a structural shock. Cutting off legacy energy systems while replacements are incomplete creates a gap that policy cannot wish away. Europe imposed hard legal timelines on energy flows that had anchored its industry for decades, that transformed energy from a stable cost into a strategic liability almost overnight. The critical mistake was not choosing transition. It was choosing rigidity. Energy systems are physical networks built over generations, not election cycles. When policymakers treat them as switches instead of infrastructures, they introduce risk faster than markets can adapt. The result was a sharp rise in energy prices and, more importantly, extreme unpredictability. Heavy industry can absorb many things, but not uncertainty. A steel plant or chemical complex is designed around long-run assumptions. Once those assumptions break, financing collapses, insurance costs rise, and boards are forced to make irreversible decisions. This is where the gap between political logic and industrial logic becomes fatal. Leaders spoke in terms of independence and values. Companies ran spreadsheets, and the spreadsheets stopped working. Even when prices temporarily fell, the damage was already done, because volatility itself is toxic. No chief executive commits billions to a plant that might be unprofitable depending on whether geopolitics or regulatory shifts. This is why short-term relief measures failed. Subsidies can offset costs for a quarter or two, but they cannot replace confidence. Meanwhile, alternative energy capacity lagged behind industrial demand. Power grids bottlenecked. Storage remained insufficient. Imports filled some gaps, but at a higher and more fragile cost base. What was framed as a managed transition turned into a rolling stress test. Industry responded rationally by freezing investment and preparing exit options. The energy decision did not just raise prices, it rewired incentives. Europe unintentionally told its industrial base that the future would be more expensive, more uncertain, and more politicized. Capital listens carefully to those signals, and when it does, the response is swift. The first sectors to break were always going to be heavy industry because their margins are thin and their energy exposure is absolute. Fertilizer production is a clear example because gas is not just a fuel, but a feedstock. When gas prices spike, production simply becomes impossible. The same logic applies to chemicals, glass, aluminum, and steel. These industries cannot relocate machines temporarily or switch inputs easily. Once a blast furnace or chemical line shuts down, the restart costs are enormous. That is why closures quickly become permanent. Economists call this demand destruction, but that phrase understates the reality. This is capacity destruction. Europe is not consuming less steel because it wants less steel. It is consuming less because it no longer produces it competitively. And here is the second-order effect most people miss. When one heavy plant closes, it pulls down an ecosystem. Suppliers, logistics contractors, research hubs, skilled labor pools all unravel together. That is how industrial regions hollow out. This is not theory. It is already visible in employment data, investment flows, and export volumes. Companies are not waiting for clarity. They are choosing certainty elsewhere. The United States offers cheaper energy and clearer incentives. Asia offers scale and long-term contracts. Europe offers neither right now. Once capital migrates, it builds new clusters abroad, and those clusters then reinforce themselves. This is why industrial decline accelerates once it starts. Policymakers often assume they can reverse course later. But heavy industry does not return because its return requires rebuilding trust, not just infrastructure, trust that energy will remain affordable, trust that rules will not shift mid-investment, trust that long-term planning is possible. That trust has been damaged. The closures we see today are therefore not the end of a crisis. They are the beginning of a new equilibrium where Europe produces less of the physical goods that underpin modern economies. And that shift has consequences far beyond factory gates. As factories shut down, another process accelerates quietly but far more decisively, and that is capital flight. Money moves before headlines catch up because investors are paid to anticipate, not to wait. Once energy costs became structurally higher and unpredictable across Europe, boardrooms stopped asking how to survive locally and started asking where to grow next. This is the inflection point most policymakers underestimate. Capital does not protest or negotiate. It reallocates. When long-term energy contracts cannot be guaranteed, investment horizons collapse from decades to quarters. New plants are postponed. Expansion plans are canceled. And crucially, the next factory is built somewhere else. This is how industrial decline becomes locked in. The United States emerged as a primary destination, not because it is perfect, but because it offers something Europe no longer does. Cheap, stable energy paired with clear industrial incentives, Asia offers a different attraction. Scale, certainty, and long-term planning embedded into infrastructure deals. Europe, by contrast, now asks investors to accept higher costs, regulatory risk, and political uncertainty simultaneously. That is not a competitive proposition. Once capital relocates, it does not just take money with it. It takes engineering teams, supplier networks, and institutional knowledge. This creates a feedback loop where declining industrial density further raises costs for those who remain. Skilled workers follow opportunity. Universities adjust research priorities. Local ecosystems thin out. The damage compounds quietly year after year. Governments attempt to counter this with subsidies, but subsidies are a bridge, not a destination. They can slow decline, but they cannot restore confidence once the investment logic breaks. Capital wants predictability more than generosity, and this is the core mistake. Europe treated capital as loyal when in reality it is conditional. The exodus we are witnessing is not dramatic, but it is decisive. It reshapes the future industrial map of the continent without a single vote being cast. The energy shock does not stop at factories, it moves into the financial system and from there into the currency itself. This is where the crisis becomes systemic. Europe imports energy at higher prices and largely pays for it in dollars. That single fact matters enormously. Every energy shipment increases demand for dollars and pushes pressure onto the euro. A weaker currency then feeds directly back into inflation by raising the cost of all imports, not just energy. This creates a vicious circle. Higher energy costs weaken the currency. A weaker currency raises energy costs further. Consumers feel this through rising bills. Businesses feel it through shrinking margins. The central bank is trapped in the middle. If it raises rates to defend the currency, it deepens the economic slowdown. If it eases policy to support growth, it risks further currency depreciation and imported inflation. There is no clean exit. This is why energy policy has quietly become monetary policy. The strength of a currency ultimately reflects the productivity and competitiveness of the economy behind it. When industrial output declines and trade balances deteriorate, currencies adjust downward. Europe spent decades building credibility for its common currency. That credibility is now being tested by forces outside the central bank's control. Energy volatility undermines price stability, which undermines monetary credibility. This erosion does not happen overnight. It happens gradually, and then suddenly when confidence shifts. Investors begin to question long-term growth prospects. Capital inflows slow. Financing costs rise. What started as an energy transition now constrains fiscal space, monetary flexibility, and geopolitical leverage. A region that cannot control its energy costs struggles to control its currency, and a region that cannot control its currency finds its economic sovereignty steadily eroding. While Europe turns inward to manage these pressures, the global system continues to move. Power does not pause out of sympathy. Other regions are responding pragmatically to the same energy landscape, and the contrast is stark. Asia has doubled down on long-term supply security by locking in contracts, infrastructure, and diversified routes. These deals prioritize price stability over ideological alignment. They reduce exposure to spot market volatility and anchor industrial planning for decades. At the same time, major energy exporters have gained leverage by becoming indispensable partners rather than marginal suppliers. Long-term contracts shift bargaining power away from buyers who hesitate and toward sellers who can choose their clients. Europe now competes for energy on short-term markets against regions that planned earlier and longer. This is not a moral judgment, it is a structural outcome. Energy security is built slowly and lost quickly. As Europe's industrial base weakens, its influence over global trade rules, standards, and investment flows diminishes. Influence follows production. Countries that manufacture control supply chain standards and downstream value. Those that import at high cost adjust instead. This is how geopolitical weight quietly shifts, not through confrontation, but through contracts, infrastructure, and capacity. The world is not fragmenting randomly, it is reorganizing around energy certainty. Europe's challenge is not that others are acting unfairly, it is that others are acting earlier and more decisively. The consequence is a redistribution of industrial gravity away from regions that treat energy as a political symbol and toward those that treat it as a strategic foundation. This transition will define global power relationships for decades, and Europe is entering it from a position of growing vulnerability. Eventually, every structural crisis stops being abstract and starts becoming personal. When factories close and energy bills rise, the pressure does not stay in boardrooms or policy papers. It moves into households, workplaces, and streets. This is where the economic shock turns into a social one. Higher energy costs filter into food prices, transportation, housing, and basic services. Wages rarely adjust at the same speed. The result is a slow squeeze that feels invisible at first and then suddenly overwhelming. Households cut back. Small businesses struggle. Regional inequality deepens as industrial areas hollow out faster than service-based capitals. This economic strain then feeds political tension because voters do not experience energy policy as a theory. They experience it as a monthly bill. Trust erodes when promised transitions feel endless and sacrifices feel one-sided. Political systems respond under stress by polarizing. Compromise becomes harder. Long-term planning gives way to short-term survival. This is not unique to Europe, but Europe's institutional structure makes it more fragile. Shared rules combined with uneven impacts create friction between member states. Some regions bear higher costs, while others weather the transition more easily. Solidarity weakens when outcomes diverge. Governments face pressure to shield their own populations, even if it fractures collective coordination. This is how economic stress translates into political paralysis. Decisions slow, reforms stall. Crisis management replaces strategy. At the same time, populist narratives gain traction by offering simple explanations for complex problems. The danger is not any single political outcome, but the loss of institutional coherence. When societies are divided and governments are constrained, their ability to respond to external shocks diminishes. Europe's challenge is no longer just industrial or financial, it is social resilience. And resilience once depleted is difficult to rebuild. A continent focused inward on managing discontent struggles to project stability outward. That loss of focus carries long-term consequences. So where does this trajectory lead? There are three plausible paths forward, and none of them are painless. The first is gradual adjustment without reversal. Europe adapts slowly to higher costs, accepts a smaller industrial footprint, and shifts further toward services regulation and imports. This path avoids crisis, but locks in relative decline. The second path is political rupture. Economic pressure forces a sharp recalibration of energy and industrial policy through elections, crises, or institutional reform. This could restore competitiveness, but at the cost of volatility and uncertainty during the transition. The third path is the most counterintuitive. Europe deliberately accepts near-term losses to rebuild a new industrial base around stable energy, long-term planning, and strategic autonomy. This requires coordination, patience, and credibility. It is the hardest option, but also the only one that changes the structural equation. None of these paths are predetermined. What matters is recognizing the nature of the problem. This is not a temporary downturn. It is a structural reckoning with how modern economies function. Industry follows energy. Capital follows certainty. Power follows production. Europe's recent choices disrupted all three simultaneously. The closures we see today are signals, not endpoints. They reveal constraints that can still be addressed if acknowledged honestly. The longer denial persists, the narrower the range of options becomes. History shows that economic systems rarely collapse from a single decision. They erode through accumulated misalignments. Europe now stands at that inflection point. The future will be shaped not by intentions, but by adjustments made under pressure. The question is whether those adjustments restore balance or entrench fragility. That decision is still open, and it will define Europe's role in a world that is no longer waiting for it to catch up. So here are the questions that matter. Can Europe rebuild industrial competitiveness without abandoning its long-term goals? And will political systems move fast enough to prevent temporary sacrifice from becoming permanent decline? Let me know what you think in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.